Good morning. I am David Berkowitz, the Chief Investment Officer of ValueAligned Partners, and this is my first quarter review for 2014. Our hedge fund was up 3.3% in the first quarter. That's against 1.3% return for other stock hedge funds like ours. Our ValueAligned portfolio, which is a model portfolio, was up 2.7%. While the S&P 500 index was up 1.8%, and that's with dividends reinvested. Real estate topped the 5 asset classes that we track. It was up 10% for the quarter, and it was up while all the other asset classes were marginally up. You can see that commodities were second, up 3% right here. The green line measures real estate. And real estate basically coincided with a drop down in interest rates in the first quarter. The 10-year yield started at 3% for the year and ended up around 2.7% now. It was a little bit lower than that at the end of January, just when real estate started outperforming. The 20-year treasury index was up over 7% for the quarter. That's pretty fantastic return for the Treasury index, considering many people thought that we were in the middle of a disaster waiting to happen because of the Fed's tapering of its quantitative easing. We thought that Treasury prices were going to go down further and we were going to get higher interest rates in a breakout well above 3%. That didn't happen, and we actually got lower interest rates. So interest rate sensitive stocks were the outperformers in the first quarter. We also had some geopolitical turmoil throughout the first quarter around the world, and energy, food, and gold were up, but the industrial metals or industrial commodities were down. We had energy and agricultural commodities or food were up 15.9%, energy up 0.5%, but natural gas was up 13% for the quarter, and that helped us because we made a very large trade in the hedge fund on natural gas, which added close to a percentage point of performance for the first quarter. We are no longer long natural gas. But the turmoil in gold prices tells me, remember, I think gold is nothing but a fear index. When people get uncertain or even fearful, especially about the global world order, what usually happens is gold starts perking up. And that's what we had in the first quarter. Gold was up nearly 7%, and the world is indeed confused about America's role in the world. They're not too sure that we're leading like we have been throughout the last 30 years or so. And just this morning, I read an article in National Review by Victor Davis Hanson entitled, "What Drives the Obama Anti-Strategy?" He writes, "The world is confused. Is the U.S. just inept, and therefore our friends and enemies for a while longer are putting decisions on hold, assuming that wiser heads in the Democratic Party or the voters in 2014 and 2016 will correct the aberration? Or is the new anti-strategy a deliberate effort to diminish U.S. influence and outsource regional problems to local hegemonies? Who knows," he writes, "but most people abroad fear that we have entered a very dangerous period. It's becoming clear that the United States cannot continue on its present course and still be the United States, and without the United States in the lead, the world cannot remain the world as we have known it since 1945, and certainly since 1980, when globalization really took off." So what we have is a period right now where there's a lot of uncertainty. There has always been a lot of uncertainty during the administration that we've had, and the change in economics, the change in regime, Obamacare, and with the change, it seems, in global American strategy. But what we follow is not headlines so much, but we follow quantitative indicators all summed up into a couple scorecards. One such model is the Hayes advisory model, and that model, if you remember, its psychology measures at the beginning of the year were at its worst, P6 measure, flashing red, which meant caution in the short term. And we had been cautious really since September of last year, and we have had significant amounts of cash in both portfolios because of our caution. And the height of it was at the beginning of this year when the dumb money, the people that are usually wrong at extremes, meaning they buy when the stock market is going up and they sell when it's going down in a panic, those people were very optimistic at the beginning of the new year, and because of that we were very cautious and kept our position in. But we're still very bullish for the long term. According to Hayes, the stock market valuation is still extremely undervalued. Not sure I agree with that. We have it near fairly valued, but that's okay. The monetary policy we agree with. It's about as friendly as it can get. And the market trend in general is an A-OK to be in stocks. Now, the market fell in January, but like we said, it's still too much optimism. There wasn't enough fear to cure all the optimism, so we maintain our 70% exposure to the market in the hedge fund and about 85% in the ValueAligned portfolio. Now, to zoom out just for a second before we go, I want to see where we are. And this has been our thesis, and this is what I think is about to happen. I think we had a breakout, and the next 10 to 15 years are going to be a golden opportunity for stock investors in particular. It's going to be a year where all the barriers to a better economic future are going to start to come down, and we're going to get a breakout into the next phase of the digital revolution. And that's going to be great, great things. We're going to experience much faster economic growth. That growth in turn is going to increase tax revenue without having to raise tax rates, which means as a proportion there's going to be a lot of private capital that's going to be churning around. Employment will go up, people will be retrained, large amounts of capital will be invested, and I think the stock market has sniffed this out already, and that's why we've got the breakout that we have up here. Now this breakout in particular comes after 10 to 15 years of progressive or government interventionist policies. First we had the war in Iraq, then we had much more centralization in the security apparatus after 9/11, the two wars, a lot of government spending, a lot of intervention in the center by the central planners. Then in 2006, the Democrats were elected to take over Congress, both houses, and then what we basically had was a period of progressive economic policies that put a lot of barriers to the private economy, and we basically have had 10 or 15 years of churning, a lot of volatility, but we've already gone through these things before. In the 60s and early 70s, we had the Great Society and its fallout in the 70s. Then we had a breakout right around 1980 or so with the Reagan-Thatcher globalization revolution of economic freedom breaking out all over the place. And also during the New Deal, we also had this period of volatility in the stock market. We had a horrible non-existent recovery because of the government intervention back then. And we then had a breakout there too when we got to much more friendly policies after the war. So I think we're on the verge of a very good 10 to 15 year period that will be the build out phase of the digital revolution that began in 1974 with the advent of Intel's microprocessor. Stocks are only about fairly valued right here. We're still cautious. We need that dumb money to get scared. But we'll continue to buy dips in the stock market and in the stocks that we like, and we'll sell into strength. We still have cash and we're ready to buy when we get the opportunity. Thanks for listening. I'll be back to you in about a week or so with an update of how we're doing in the second quarter. Thanks. Have a good day.